Hi, Andrew here again. In my last video, I explained about my investment philosophy and how an important part of that is something called factor investing, which is how academics have identified the sources of return and grouped them in particular characteristics. In this video, I'm going to explain a bit more about each factor and why it exists. So the first factor identified was that of the market, and it says that over the long term, stock markets will outperform every other asset class. As with any investment, we have to expect that we have short-term volatility, short-term uncertainty, if we want to benefit from the long-term consistency of those returns. Because no investment is guaranteed, and we have to embrace that uncertainty if we want to be rewarded over the long term. But we can reduce the risk by diversifying broadly across many companies in the stock market, because research has also shown that it's notoriously difficult to beat the stock markets on stock selection alone. There are very few fund managers who are skillful enough to identify one or two winning stocks and beat the market just through that stock selection. You're better to invest more broadly and accept the market returns as a whole. The size factor was all about the fact that small companies tend to outperform larger ones. Now, we're not talking about micro caps here. These are still companies that have a market capitalization of between $300 million and $2 billion. So still large companies, they're just not very large ones. And this research goes back to 1936 and shows that as investors, we would expect to be rewarded for any additional risk that we're taking on with our money. And because smaller companies tend to have more debt, be less profitable, have less cash, and be more volatile, they are inherently more risky. So by investing in them, we can expect over the long term a greater return than investing in the stock market as a whole. Value companies are those where the share price is low relative to the value of the assets. Now, we all like shopping in the sales and getting a discount for the things we buy. Value investors do the same. They're investing in companies where the shares are at a discount on the expectation that there will be a share price recovery. So it's companies that are unloved, are undervalued for any particular reason. Often they might have high debt, or they're facing uncertainty of earnings or future earnings for any particular period. Now, of any of these factors, they're often human bias explanation for why they exist. And with value, it can be down to something called recency bias, and that's where we tend to look at short-term news, short-term performance, and extrapolate that over the long term, expect short-term returns to continue over the long term. And there's also something called loss aversion. We tend to feel the loss of a pound more than we do the gain of a pound, and investors look at the short-term potential loss of companies that are defined as value and think that will continue, and more concerned about that loss than the potential gain, so they'll avoid them. And that, for value investors, creates opportunity. And a good example is the airlines during the pandemic. When the world economy went into lockdown and no one was travelling, the share price for airlines fell dramatically, between a third and up to 50%. But as soon as a vaccination program started to be rolled out and lockdown was easing, the expectation for the airlines improved over the long term, not the immediate term, but over the long term. So value investors who were owning airline stock benefited from that uptick when the news flows changed. The momentum factor is all about how short-term movements in prices, positive or negative, tends to continue for a period of time. And so momentum investors can ride that wave until it breaks. And again, it's about using behavioural biases. One of them known as the frog in a pan. And you might have heard about the theory that if you put a frog in boiling water, it would jump straight out because it would notice the temperature difference. But if you put it in cold water and slowly raise the temperature to boiling, it doesn't notice, and the poor frog will boil to death. As investors, we tend not to notice short-term price movements or even short-term news flow, so changes in earnings announcements. So we miss out these price movements. So momentum investors can ride that wave on the upwards trend or avoid a downward trend and benefit from the positive or negative flows. And it's also to do with recency bias, where we extrapolate short-term good news or bad news over the long term and expect it to continue. Cryptocurrencies or investing in Apple or any of those companies that have done particularly well is a classic example. People look at the short-term movement and expect it to continue, so buy in. And so momentum investors can have that short-term wave for a period of time and then get out again. And another classic is that herding. So same idea, cryptocurrencies, Apple shares, Google shares, whatever it might be. We all herd together, which generates that price movement. So momentum investors benefit from that herding for that short period of time. And then minimum volatility is about is measuring the variation in share price movements, so that volatility. And companies with lower share price variation tend to outperform companies with higher price variation. And the reason behind that is investors tend to prefer the high profitability, low probability opportunities. Think about the lottery effect, that people will put all their money into buying a lottery ticket because there's a chance of hitting the jackpot, even though the probability of winning is very low. So high profile investments have a higher demand, leading to higher valuations and greater price variation. But by investing in minimum volatility, we can reduce the risk of a portfolio as a whole, so it's a dampening effect on the portfolio. And quality companies are those where profitable companies tend to generate higher returns. They have stable earnings, low debt, cash rich, and might be dominant in their market. So they tend to be high growth companies. And because they're high growth companies, it's a really good hedge against the value factor. So again, a diversifier, investing in uncorrelated factors to get higher risk adjusted returns. And the quality factor exists because investors expect returns to revert to the average sooner than they actually do. So they will sell sooner than they might otherwise should do. And again, similar to the previous factor, they tend to prefer the lottery ticket returns of high returns, low probability events of less profitable firms. So they think if we invest in less profitable firms, we can do really well with our investments, even though the evidence shows that profitable companies tend to generate higher returns. So that's each of the factors. What you can see here is how they might go through the cycles and how the different biases are mapped onto them. So a value stock might become a momentum stock when it becomes loved again, when investors think there's positive news flows for it, so its earnings are better. And a momentum fund that might become a growth stock, which then might peak and become a momentum stock on a downside. And it's all to do, or often to do, with the biases we have as investors, be us, we retail novice investors, amateur investors, or even expert investors to professional investors too. So that was the explanation into factors and why they exist. Hopefully it was helpful. Hopefully it gave you a bit more insight into how I invest money on behalf of my clients. If you've got any questions, please do get in touch.